If you needed to move $250,000 tomorrow, could you do it without asking anyone? What about $2 million? When the bank gets nervous or the credit line disappears, what about $20 million with 72 hours to close and no time to explain? At what point does your system start to crack under the weight of speed? Why do you still need permission to access capital you already earned and already control? The difference isn't intelligence, it isn't experience, and it isn't how much capital you have. It's whether your capital is structurally free to move. November 2024, a $500 million real estate operator with a 30-year banking relationship, perfect credit history, and $12 million in deposits identifies a distressed commercial portfolio trading at 40% of replacement cost. The purchase price, $18 million. Opportunity window, 72 hours. He calls his private banker. I need to wire $18 million by Friday. The response? We'll need to review the transaction and the timeline is going to be 7 to 10 business days for credit approval. He had a backup plan. Margin loan against his brokerage account. Rejected. Markets were volatile and collateral requirements increased. Home equity line. Available, but required appraisal and underwriting. The timeline for that was going to be 3 weeks minimum. Private credit line. The terms changed during the review process. The rate increased from 7% to 11% due to market conditions. He had $50 million in liquid net worth. He couldn't deploy $18 million in 72 hours. The deal closed. Cash buyer, no approval required, no contingencies. 18 months later, that portfolio sold for $48 million. Not because he lacked capital, because every path to that capital required permission. Permission is a tax wealthy people pay that never shows up on a balance sheet. That's why I call it a hidden tax, because no one ever sends you a bill, but you always pay it. These are the 5 costs of asking permission. Beyond fees, permission-based capital systems impose 5 structural costs that never appear on a statement. Institutions measure these costs before they measure returns. Let's start with the first one, opportunity cost. Let's look at 2 very different capital structures operating in the same crisis. 2008, the credit markets have frozen. Distressed assets are trading at 30 cents on the dollar, but only for buyers who can move without bank approval. Warren Buffett had that kind of capital. His reserves were pre-positioned. He didn't need to apply. He could deploy in 48 to 72 hours. And he did, to the tune of $26 billion across 5 deals. Now compare that to the Yale endowment. Their structure was over 80% tied up in long-term, illiquid investments. So when liquidity dried up, they couldn't go on offense. To cover their obligations, they had to borrow about $2.5 billion, not to invest, just to survive. And when the pressure continued, they sold off long-term assets at a discount. They weren't buying the dip, they were managing a liquidity crunch. Same market, different capital structure. Buffett didn't outsmart Yale, he outstructured them. Cost number 2, cognitive cost. Princeton University, 2013. Researchers measured cognitive function under financial stress. You've got to hear this. The finding, financial scarcity consumed cognitive bandwidth equivalent to 13 IQ points. That's the difference between average and superior cognitive function. Apply that to capital access. You're structuring a $40 million acquisition. The capital exists, $80 million in liquid net worth, but it's allocated across private equity with 6-year lockups, real estate equity requiring refinancing, brokerage accounts where liquidation triggers capital gains tax, and operating business capital you can't extract without disrupting cash flow. You're not solving a capital problem. You're solving a permission problem. Which assets do you liquidate? What tax consequences do you trigger? Which bank approves fastest? What documentation satisfies underwriting? That's cognitive load. Institutions don't carry it. Third cost, strategic cost. There's a class of opportunities that only exist for operators who don't need approval. Distressed sellers with 48-hour timelines, bankruptcy liquidations with cash-only terms, pre-foreclosure real estate priced for immediate close, private equity secondaries trading at 20% discounts to NAV. These don't get listed on platforms. They get transacted by operators with contractual liquidity. Speed is pricing power. When your capital structure requires approval, you're architecturally excluded from time-compressed opportunities. That's not a temporary disadvantage. advantage, that's a permanent structural ceiling. The fourth cost is identity cost. You've built $700 million net worth by executing without friction. Opportunity appeared, capital moved, deals closed. That was your operating system. Now you're wealthy, and suddenly accessing your own capital requires permission. From a 32-year-old relationship manager who needs approval from the credit desk, who needs approval from the regional director, who needs approval from the credit committee, you went from operator to supplicant. That's not a financial cost. That's an identity cost. And it's costly in ways that don't show up on tax returns. The fifth cost, certainty cost. How much time do you spend not knowing? Not knowing if the bank will approve, not knowing if underwriting will change terms, not knowing if opportunity will still be available. Institutions don't operate in that fog. Certainty is the first asset institutions buy. Not returns, not growth, certainty. Because certainty eliminates decision paralysis. So how do the institutions actually structure their capital? Well, they split it into 3 tiers, and each one has a job. Tier 1 is reserve capital. It's about 20 to 30% of total assets. This is where liquidity lives. Real liquidity, not what's available if the market cooperates, but capital that you can access with a phone call. No approvals, no delays. It doesn't swing with the market. It doesn't flinch in a crisis. This is your certainty layer. It's what allows everything else to move with confidence. Tier 2 is growth capital. This is the bulk of the portfolio. 50 to 70%. Stocks, private equity, real estate, alternatives, all the compounding vehicles. This tier is meant to move up and down. The volatility is totally expected. It's even welcomed because tier 1 is already doing the job of keeping you stable. So this layer can focus on what it's designed to do, to grow over decades. And then there's tier 3, the opportunistic layer. This is 10 to 20%. Think of it as dry powder. It's reserved for the crisis moments that most people fear, but this isn't panic capital. It's predator capital. When markets crash or assets get distressed, this tier moves fast, 48 to 72 hours fast. And because you're not scrambling, you're in position. This tier is where asymmetric returns are born. Notice what's first, not growth, not maximizing returns, but reserve infrastructure. Because liquidity without permission is the foundation of every other strategy. Here's something almost nobody knows. US banks hold over $200 billion in a single asset class. Not for growth, not for yield, they hold it for reserves. It's called bank-owned life insurance, or BOLI. And here's what that actually means. BOLI is a cash value life insurance policy that the bank owns on its own balance sheet. The bank is the owner, the bank controls the cash value, and the bank uses the cash value as reserve capital. This isn't insurance the way that consumers think about insurance. For banks, it's a balance sheet asset designed to hold value, provide liquidity, and stay accessible during stress. That's why regulators treat it differently. Under Basel III, the global banking framework created after the 2008 crisis, banks are allowed to allocate up to 25% of their Tier 1 capital to BOLI. Why would regulators allow that? Because BOLI behaves exactly how reserve capital is supposed to behave. First, contractual liquidity. Banks can borrow against up to 90% of the cash value, using the policy as collateral. No credit check, no approval process. Access within 48 hours. Second, balance sheet stability. The cash value isn't tied to equity or bond markets. In 1929, in 1987, in 2008, and in 2020, it didn't crash, it didn't freeze, and it didn't get margin called. Third, tax efficiency. The cash value grows tax deferred. The loans are not treated as taxable income, and the death benefit passes tax-free under the IRC Section 7702. And finally, regulatory validation. Basel III designates BOLI as Tier 1 capital because it remains accessible when everything else breaks. Now compare that to what most advisors recommend as liquidity. What banks use? BOLI, a contractual reserve system, accessed by collateralized loan, no approval, 48-hour deployment, not market correlated, Tier 1 approved. What retail investors are told to use? Brokerage cash or money markets. benefits, access by liquidation or margin loan, triggers taxes or margin risk, callable in a crisis, not recognized as reserve capital. Banks don't use BOLI because it's clever. They use it because it's structurally superior. So the real question isn't whether it works. The real question is, why were you never shown how banks actually hold reserves? Permission isn't binary, yes or no. It's probabilistic. You apply for a $10 million credit line. The bank's response? We'll review and get back to you in 7 to 10 business days. That's the first uncertainty. Then the clock starts. Week 1, waiting for underwriting to complete initial review. Week 2, additional documentation requested. Appraisals, entity verification, updated financials. Week 3, credit committee review scheduled, then postponed. Week 4, conditional approval offered. The rate increased, collateral requirements have been expanded. What was promised as 7 to 10 business days becomes 30 to 90 days of iterative uncertainty. You're not waiting for an answer. You're operating in a probability distribution. 60% chance of approval at revised terms. 20% chance of conditional approval requiring additional collateral. 15% chance of rejection, 5% chance of indefinite delay pending internal review. Institutions eliminate this fog entirely. They structure capital with contractual certainty, not probability. Certainty compounds, uncertainty erodes. Let me give you a real-world example from March 2020. Markets dropped 35% in 30 days. Credit markets froze. You've got $30 million in brokerage accounts. A distressed real estate deal hits your desk. $15 million, deep discount, but it closes in 48 hours. Can you move? Let's look at your options. Option 1, sell equities. You could liquidate your portfolio. You'd get cash instantly, but you'd lock in a 35% loss and trigger capital gains taxes. Worse, the market recovered 60% in the next 12 months, so you sold low, paid taxes, and missed the rebound. Option 2, margin loan. Approval takes 24 to 48 hours. Maybe, but rates are up 6 to 8%. And if the market drops again, your loan could get called, and then you'd be a forced seller in a crash. Option 3, bank credit line. What about your bank line? In March 2020, banks stopped lending. Credit froze. Your line is useless. No access. Option 4, contractual reserve access. Now imagine you had a contractual reserve, a policy-backed capital pool. You open up an app, process a collateralized loan, 48 hours, no approval needed, 5% cost, not margin called. You deploy the $15 million, the deal closes, and your brokerage portfolio still intact. It rides the recovery all the way back up. Your liquidity only matters if it's accessible when you need it most. Institutions learned this in 1929, 1987, 2000, 2008. Retail investors relearn it every crisis. Let me tell you about a movie scene from a movie called Miami Vice. It's the 2006 version by Michael Mann that's always stuck with me. I watched it years ago, and I just sat there thinking, after watching this particular scene, I remember thinking, man, this feels so different. Jamie Foxx and Colin Farrell, they're undercover, and they're posing as drug runners. So they're heading to meet a cartel boss. Before they arrive, something really weird happens. They're in the middle of a city, but they look at their phones, and their phones lose signal. It's like a comms glitch. So they glance at each other, and then they instantly clock it. This wasn't random. The signal was deliberately jammed by the technology of the cartel boss. So that's your first clue. The guy doesn't just have money, he's got infrastructure. The meeting actually takes place in an armored van. There are no greetings, there's no talk, there's not one line from the Americans. The van has no windows because glass is a liability. So if you expect danger from ambushes or rivals, you don't build with windows, you build with armor. So instead of glass, they were installed with something else. The inside of the van was lined with these ultra-thin screens that showed the world outside in real time. So it was basically camera feeds projecting what was outside, inside on those screens. This man, you can tell, he doesn't wait for danger. He assumes it, and then he designs around it. So anyway, in the scene, he finally speaks. Calm, kind of cold, but clear. And he says, in this business, I do not buy a service. I buy a result. If you say you will do a thing, you must do exactly that thing. If you do, you will prosper beyond your dreams. And then he wraps up what he's saying by saying, I extend my best wishes to your families. There were no goodbyes, no handshakes. There was just a nod from the cartel boss toward the door, letting everybody know that the meeting was over. And recently, when I thought about it, the illustration clicked, because obviously this connection is not because institutions are criminals or because family offices or drug traffickers, but the way they think. Structurally, it's almost identical. They don't improvise. They don't wait for risk to show up. They assume that uncertainty is constant, and then they design around it. They don't buy services, they buy outcomes. They buy results. They don't hope that systems hold up. They build systems that hold up. And most importantly, they never leave access, timing, or control up to someone else. That's the piece that most people never see. See, institutions don't eliminate uncertainty. They relocate it. The average investor lets uncertainty live in all the wrong places. Timing, access, permission, liquidity. Institutions refuse that. They move uncertainty away from survival, and they let it live where it belongs. And by that I mean they let it live in which opportunity wins, how big the upside is when the returns show up, but never will I be able to move when it matters. That's the difference, because institutions don't try to predict the future. They design systems that survive any future. Most advisors don't avoid institutional reserve structures because they're unprofitable. In fact, insurance can be extremely lucrative. First-year commissions, renewal income, residual compensation structures. The real issue is simpler and a bit more uncomfortable. Most advisors have spent their entire careers inside an accumulation paradigm. They're trained to grow balances, optimize returns, and manage volatility, not to design balance sheet architecture that prioritizes certainty, access, and deployment speed. Institutions don't think that way because they're smarter. They think that way because they operate under different constraints. You can't teach what you don't know. You can't recommend what you've never relied on. If you've never had to deploy capital in a 72-hour window, if you've never structured reserves to perform during credit freezes, if your own balance sheet depends on market liquidity rather than contractual access, then it's very difficult to recommend that kind of architecture, let alone explain it with confidence. Advisors are competent. They're well-intentioned. They operate inside a system, though, that they were trained to navigate. But that system, the accumulation model, it doesn't ask the question that institutions ask first. How do I ensure this capital is accessible during the exact moment I need it most? Instead, the accumulation model asks, how do I maximize returns during favorable market conditions? Those are fundamentally different questions, and they produce fundamentally different capital structures. You have more financial information than any generation in history, but do you have more control? Look at the difference here. You have information about real-time market data, portfolio performance analytics, tax optimization strategies, investment research and trends, and economic forecasts. But what do you actually control? What you don't control is when you access your capital, whether the bank approves your loan, how long approval takes, if terms change during underwriting, or whether margin loans get called during volatility. Information feels like progress. Institutions don't optimize for information. They optimize for control. Here's the irony most people never see coming. The more your net worth grows, the less access you often have to it. Why? Because real wealth usually gets locked up inside structures that aren't built for speed. Let me show you what that looks like at the top. Imagine a $700 million net worth. $300 million in commercial real estate. Sounds great, but it's illiquid. You need to refinance just to extract equity. $200 million in private equity, locked up for 7 to 10 years. There's no early withdrawal. $150 million in brokerage accounts. Technically liquid, but a sale triggers capital gains taxes and introduces timing risk. $50 million in operating businesses? Yeah, when you pull that cash, you'd be disrupting cash flow. So what's actually accessible? Without permission, without penalty, without delay? Nothing. You're asset rich and liquidity poor. That's not a feature of wealth, man. That's a structural flaw. Let me quantify what permission costs over 20 years. Scenario 1. the $40 million missed acquisition. Year 5 of wealth building, distressed commercial real estate portfolio. Fair market value, $80 million. Asking price, $40 million. You have the capital, but it's spread across private equity lockups, real estate equity requiring refinancing, and brokerage accounts where liquidation triggers tax consequences. Closing timeline, 72 hours. Your capital access timeline, 30 plus days. Deal closes, cash buyer, no contingencies. Here's what that cost. Purchase price, $40 million. 50% discount to fair market value. Immediate equity created, $40 million. 10-year appreciation at 5% annually, $25 million. Total value after 10 years, $65 million. Capital you had, $40 million plus across multiple accounts. Capital you could deploy in 72 hours, $0. Opportunity cost, $65 million. That's not hypothetical. That's back tested. Let's go back to March 2009. The S&P 500 has just bottomed at 666, down 50% from its peak. It's the darkest moment of the 2008 crisis. You've got $80 million in liquid net worth, all in brokerage accounts, and they're down 45%. You want to go on offense. You want to deploy $20 million into distressed equities. But here's the question. Can you move without taking a loss? Option 1, contractual liquidity, no liquidation. If your capital was pre-positioned, ready to deploy without liquidation, you drop $20 million into the S&P at 666. Just 12 months later, you're up 69%. That's $33.8 million. A gain of $13.8 million in 1 year. Stay in for 5 years, that's a 210% return. Your position grows to $62 million, a gain of $42 million. Option 2, permission-based capital. Must liquidate first. But if you need to liquidate to access cash, first, you lock in a 45% loss. Then you trigger capital gains taxes. Then wait days, maybe weeks, to reposition your capital. By then, the bottom is gone. The recovery is already moving, and you're watching it from the sidelines. The cost of delay, the opportunity cost of not having pre-positioned, no permission liquidity, $42 million. Again, that's not theoretical, that's historical. Let's zoom out. Over 20 years, imagine that you missed just 3 time-sensitive opportunities, not because you lacked capital, but because you didn't have permission-free access. Here's what that actually costs. Missed opportunity number 1 in year 5. You pass on a $40 million opportunity. That alone is a loss. But if it had compounded at 7% annually for the next 15 years, that one miss becomes $110 million. Missed opportunity number 2 in year 12, another one slips by. $25 million left on the table. 8 years of missed compounding, now it's $43 million. Missed opportunity number 3 in year 18. One more, $30 million you couldn't move fast enough to capture. Even just 2 years of compounding turns it into $34 million. Add it up, direct missed gains, $95 million. Total compounded cost over 20 years, $187 million. And here's the part that hurts the most. None of this shows up on a statement. There's no red ink. There's no alert. There's no bill. Permission is a tax that compounds in reverse. Here's what it looks like when a $700 million portfolio transitions from permission-dependent to institutionally structured. Let's take a look at the permission-based structure first. $300 million in commercial real estate, illiquid. $250 million in a brokerage, liquid on paper but comes with tax hits and timing risk. $100 million in private equity, locked up for 7 to 10 years, forget about it. $50 million in operating businesses, but extracting cash disrupts operations. How much capital can you actually access without approval or penalties? Zero. Not a dollar. Let's look at the institutional reserve structure. $140 million allocated to cash value life insurance with contractual access to $126 million through policy loans. $300 million still in real estate, no change needed there. $180 million in brokerage, now insulated by reserves, so volatility is no longer a constraint. $80 million in private equity, exposure reduced, flexibility increased. Now how much is accessible on demand? The $126 million, no liquidation, no approvals. no tax events. What changed? Liquidity went from 0 to $126 million. That's an infinite increase in deployable capital. Permission risk eliminated. Crisis optionality restored. You didn't change what you owned. You changed how it was structured. Most people hear life insurance and think premiums, death benefits, maybe estate planning. But cash value life insurance, or CVLI, is something else entirely. It's not about dying, it's about liquidity while you're alive. CVLI functions like private reserve infrastructure. Here's what that actually means. Contractual liquidity. You can borrow up to 90% of the cash value using the policy as collateral. No credit check, no income verification, no underwriting, just a phone call or a few taps in an app. Funds land within 48 hours. No approval needed because you already own it. Tax sovereignty. Cash value grows tax deferred. Loans, tax free, not treated as income by the IRS. And when you pass, the leveraged death benefit goes to your heirs tax free under IRC section 7702. No capital gains, no income tax, no estate tax. Crisis stability. CVLI isn't tied to the stock market or the bond market. It performed the same in 1929, 2008, 2020. It can't be frozen. It can't be margin called, and it doesn't collapse when credit markets do. Tier 1 capital equivalent. This is the same structure U.S. banks use for over $200 billion in reserves. It's been recognized by Basel III as Tier 1 capital since 1988. So no, this isn't life insurance. This is private reserve infrastructure. And it gives you something traditional portfolios never could. Access without approval, stability without correlation, and control when everyone else is waiting for permission. Q1 2025. Harvard and Yale both announced they're selling off pieces of their private equity portfolios at a discount. Why? Because they need liquidity just to cover operating expenses. And over 70% of their portfolios are locked in illiquid alternatives. Let's look at the breakdown. Harvard, $53 billion endowment. 39% in private equity, 11% in venture capital, 5% in real estate. That's 55% illiquid. Yale, $41 billion endowment, 41% private equity, 17% venture capital, 8% real assets. That's 66% illiquid. So what happens when cash gets tight? They start selling private equity stakes on secondary markets at 10 to 20% below NAV. On a $10 billion private equity book, a 15% discount means $1.5 billion gone. Not because the investments failed, but because they couldn't wait. Same market, same asset class. But while they're selling at a discount, sovereign wealth funds with pre-positioned reserves are buying. One side is scrambling for cash. The other side is buying the dip. Liquidity is worth more during a crisis than growth during a boom. My name is Christopher Hemmert. I'm the founder of the War Chest Principle. I build capital systems for families and firms who are done waiting on banks and tired of asking for permission to move capital they already control on paper. I study how institutions build access, how they borrow without selling, deploy in 72 hours, and move with zero delay. Then I help private operators do the same, so they can move, acquire, and deploy without ever needing to liquidate or explain. You've earned your income. Now it's time to earn your freedom by thinking the way institutions do, by building a system that works without you, and by protecting the one thing you can never earn back, your time. If this hits home, subscribe. The channel's small for now, but not for long. I only teach what the wealthiest families and institutions actually do because they've figured out what works, and I think you deserve the same. So keep building for the generations you won't meet until you meet in heaven. God bless.